So in Forex trading, we have what we call order types. And order types enable you to either place your trade immediately, or if you have something like a day job that takes a lot of your time, you can program on your trading platform or your MT4, you can actually program your computer or program your software to place the trade on your behalf or manage the trade in your absence. And that is what we call order types in Forex, all right? So that is what we're going to be covering on today's video. Hello everyone and welcome to the channel. My name is Ndema Zegolov. On this channel, we talk everything about Forex, trading, personal finance, and tips to help you stay profitable as a Forex trader. So if this is your first time coming to my channel, please hit the subscribe button below to subscribe to the channel so that you can be able to stay informed once I come up with relevant content like this. So with that being said, let's see what we'll be covering on today's video. On today's video, we'll be covering things like types of orders in Forex, because in Forex we have two orders. We have what we call market orders and pending orders. So we shall be covering that on today's video. We shall also cover what we call limit orders. We shall cover what we call stop orders, stop loss order, and trailing stops. So these are very important points when it comes to Forex trading. Even if you are a pro trader, you have to still be coming back to these basics, to revise these basics from time to time so that you stay on the edge. So this is very important and we'll be able to cover it on today's video. So in Forex trading, we have two types of orders. No matter what you are trading, whether you are trading indices, stock, or Forex, or whatsoever, we have two types of orders. We have let me push this somewhere closer. So in Forex trading, we have what we call market orders and we have what we call pending orders. Just as the name goes, with market orders, you either buy or sell, and your trade or your action is executed on the market immediately. All right. So for example, if I open my chart, if I open my MT4 or any platform I'm using to trade, and I place buy or sell on market orders, the trade is placed immediately. So you have what we call instant execution. The trade is executed immediately because I'm sending my trade, I'm sending the instruction, I'm sending the action directly to the market. So that is what we call market orders. So you either buy or sell and your trade is executed immediately. And here you can see some points we have here. We have some points like instant execution. You have instant execution when it comes to market orders. You have no requote. Because with pending orders, when I'll be explaining pending order to you guys, there are some situations where you can actually place an order in the market, but before that place is executed, there might be what they call a requote. A requote is just a change or a fluctuation in a currency exchange rate. Maybe by the time you set a market to place that trade, you put on your software that, okay, if the market gets to 1.5, I want to be able to buy. But now it gets there and the volatility was very high. Because of that high volatility, you can have what they call a requote. But for market execution, there is no instances where you have a requote. And now you also open a currency at the market price. So when you also use market orders, when you also use market order, your trade is open at the current market price. So there is no situation where you press buy, then it takes time. That latency, there's something in Forex we call latency, which is a delay in your broker or your platform where you are using. So you have to use a broker that is having fast execution. So in market execution, there's no situation where you place buy and the market keep loading, your chart keep loading before executing. If you find a broker there, when you place buy, it slow load before it opens, it means something is happening on the background. What is happening on the background is that when the time you place buy or sell, the time it is loading, they are actually changing the price on the background. So before that trade is either bought or sold, the price must have changed. That's why sometimes you place buy and sell, and by the time your trade is open, you are already down in the deep. You are already down in the negative. Your account is already on the red, deeply on the red, because of what we call a requote. So try to use the best brokers that don't have requote. Brokers that have milliseconds. Immediately you place your trade, the trade should be able to open immediately because you are using a market order. Talking about the broker, if you want to use the same broker I use, which have no record, no market man, everything, the best broker, the same broker I use, there's a link below. You can just choose IC Market. There's a link to sign up below so that you can sign up using the right broker. All right, so make sure you are trading with the right broker. Make sure you are trading with the right tools. That is that about market orders. After market orders, we have what we call pending orders. Under pending orders, we have something like the buy stop. We have something like the buy limit. We have something like the sell stop. And we also have something like the sell limit. So pending order, just as the name goes, you set the orders. You give the order to the market. On your chart, it's very easy to set pending orders. On your chart, you give the market instructions that, okay, when the price gets to this particular level, I want to either buy or sell. All right, when the market gets to the particular level, I want to either buy or sell. So that is what we call pending orders, because the execution, the action is taken without your presence. The action is taken after you must have given the instructions to the market. So maybe you might even place a buy stop or a sell stop that the trade will be placed maybe 3 days from now, or maybe 4 hours or 5 days, or maybe a week from now. That is why it is called pending orders, because it is an order you put in the market that will only be executed at the recent or at the later stage, or at the later day, or at a later time. That is why it is called a pending order. And here you can see the order to trade to open at a set time. So you set an order for the trade to open at a set time or date. All right, at a set time or date. And then you also have, there might be a requote. Good, there might be a requote. So you have to be very careful when you are using pending orders. Since the market will only be, the trade will be executed at a later time, or at a later date, or a later day, there can be an instance where you actually have a requote. Maybe you want to buy Great Britain pound USD at 1.2345. But by that time, the place is actually, by the time you are actually placing the trade, or at the later date or day where you are placing the trade, there can actually be a requote where you instead be entering the market at maybe 1.2356. That means you already deep or negative in the number of pips. So when you are using pending orders, just know that, okay, there might be a possibility of a requote. That means you have a different quote. You have a different quote or a different different currency exchange rate. So there might be a possibility of requote. And also price execution level might vary. All right, so the price execution levels might vary. Maybe you want to enter the same thing, you want to enter at 1.2345, but by the time you are actually getting into the trade, the price might actually vary, because you don't know the volatility. You don't know the market volatility at that particular point in time. So those are the points you just have to have at the back of your mind. All right. So with that being said, let's go to what we call limit orders. Limit orders. Anytime. Let me just give you guys this shortcut to be able to understand the difference between stop orders and limit orders. Now we are talking about pending orders. A limit order is a type of a pending order. Under pending orders, you have what we call limit orders and stop orders. Please I hope you are writing this down just the same way I'm saying it. Under market orders, we have two orders. We have under types of orders in Forex. We have market orders and we have pending orders. All right, market orders and pending orders. Under market orders, we just have the buy and sell. You buy and sell immediately. But under pending orders, we have limit orders and we have stop orders. Now we are talking about limit orders. Under limit orders, we have what we call buy limit. We have what we call the buy limit, and we have what we call the sell limit. All right. So this is now under pending orders, we have limit orders, and under limit orders we have what we call the buy limit, and we have what we call the sell limit. So what is the buy limit and what is the sell limit? Let me use this chart to explain to you. If you follow the explanation the way I'm going to explain it will be very easy. So let's just assume, right? Let's just assume at this particular point of the chart, you knew very well that at this particular point, the chart is going on, and maybe you had a resistance. You had a resistance somewhere here, and you had another resistance here. All right. So you had a resistance. You had a support here and a resistance, and you had a support. You had a support somewhere here. But now the current market price was here, and you knew very well that, okay, since you had your resistance somewhere here, once the market gets to that particular resistance, there is a possibility that there might be a reversal at that particular level. All right. So since you knew very well that there might be a possibility that there might be a reversal at this particular level, what you use at this particular level is what we call a limit. All right. It's what we call a limit. And at this particular level, since you want to be able to sell at this particular level, you use what we call a sell limit. All right. So here you actually come here and you place your sell limit. So that sell limit, you just go on your chart. Here you can see this is an example of an MT4 and MT5 chart. So you just go on your chart at this particular level. You just right click. I already have videos that show you how to place this on your chart, but this is the explanation. You just go on your chart. You right click somewhere here and you choose sell limit. So you adjust it very well and you put on that particular level where, okay, you are telling the market that, okay, even though the price is still here, if the market keeps going up, as soon as it gets here, I want to be able to sell at this particular point. All right. So let me use a different color so that we can be able to. So you are telling the market that, okay, if the market keeps going up, when it gets to this, I want to be able to sell at this particular level. And see what happened. The market came up to this particular resistance, and at that particular level, it sold. At that particular level, the market went in the opposite direction. So before the market went in this opposite direction, remember our sell limit was here. So immediately the market got to this particular resistance, it triggered our sell limit. This is in our absence. Once you already put your sell limit, you go to your job, or you go to your school, or if you're a student, you go to class. All right, you don't have to be present. So you already place your sell limit at that line. You already go on your chart and place your sell limit, and the market keeps going up. Immediately it reached at that particular line or where you place the sell limit, the trade was triggered. The sell trade was triggered, and the market keeps going. The market started going on the opposite direction, even on your absence. So even before you came back from your job, or before you came back from school, or wheresoever you were already deep in profit. You were already in the money. We call it in the money. You were already deep in profit. So that is the use of a sell limit. A sell limit, either when it comes to limit orders, either buy limit or sell limit. Buy limit or sell limit are used to catch reversals in the market. Just put that at the back of your mind. Buy limit or sell limit are used to catch reversals in the market. So they are used to trade market reversals. Remember, the current market price was here, and we foresaw very well that there was a possibility that the market will change direction at this particular level, or there was a possibility that the market will reverse. The market will reverse at this particular level. So we put our sell limit somewhere here. Remember, this is sell limit, not stop loss. We put our sell limit. We put our sell limit somewhere here. And what happened? The market came up, hit our sell limit, and went immediately on the opposite direction. So that is what happened. You have to know sell limit and buy limit are used for market reversals, to catch reversals in the market. So I've just explained sell limit to you guys. So from the explanation of a sell limit, can you be able to maybe explain a buy limit, right? I already explained a sell limit. Maybe the market is going up and you have a particular presumed level that you know that, okay, if the market gets to that level, you want to be able to sell, you want to catch a reversal. So a buy limit is just the opposite. So let's assume for a buy limit, let me take this for an example. So for a buy limit, let's just assume the market was somewhere here, right? Let's just assume the market was somewhere here. This was the current market price. And now we had our support here, and we also had our resistance here. All right. Now we saw very well that there's a possibility that since the market is going down, if it gets to this particular support, there's a possibility of reversing. So what we put at this particular support, what we put at this particular level will be a buy limit. All right, will be a buy limit. So we'll just come here on our chart, we'll just click and we'll put a buy limit and see what happened. The market came, triggered the buy limit, and went immediately after that on our intended direction. So we were able to use that buy limit to cash this reversal. All right. So this same thing I've just drawn here is the same thing here. Can you see? So this same thing, this same line, this is the same thing. This is the same thing here. This same coming to bounce here and go up, because we were trying to catch this reversal. And the same thing I drew here, the same thing. Remember, I also had something here when I was explaining sell limit. The same thing I drew here is the same thing here. And the same thing I drew here is the same thing here. So can you see? Can you see how interesting it is when you already just have this at the back of your mind? You just know very clearly that limit orders are used to cash reversals in the market. Why? When you start talking about orders, when you start talking about stop orders, now we are talking about trend continuation. We are talking about trend trading. When you are talking about trend trading, that is where you then come to what we call order types. You stop orders. Because you have limit orders and stop orders. Limit orders are used to cash reversals in the Forex market, while stop orders are used for trend continuation. So come with me to the chart. Let me show you an example now. This one is very, very easy. It's very, very easy. Because if you follow most of my videos, even the strategy on news trading, the strategy on how to trade the news, what we used to use all the times is what we call stop orders. All right, because we're trying to trade with the market. We're trying to trade that with a trend. We're trying to trade with a trend. So when you want to trade with a trend, what you use is what we call stop orders. And this is how you use stop orders. Let's just assume. Let's use this same example. Let's just assume the market was somewhere here, right? The market was somewhere here, but you knew very well that if the market gets to this particular level, there's a high potential that the market might continue going up. So what you instead put here is, you are telling the market that, okay, I want to jump in at this particular level. And since it was an uptrend, what we'll put here will be a buy stop. All right, so we'll come at this particular level on our chart. The current market price is still here, but we'll come on our chart here. Remember here, this is where we'll be reading the figures. So we'll come on our chart and here we'll put buy stop. That buy stop is telling the market that, okay, if it keeps going up, if it gets to this particular level, I want to be able to jump in. The same explanation goes for a sell stop. So I already explained to you guys, this is a buy stop when you are trying to follow the bull market. All right, the buy stop is when you are trying to jump into the trend and follow the bull market. Now let's just assume you have a prediction that the market will keep going down, but you have a level where you want to be able to join the bearish trend. What you use now is instead what we call a sell stop. A sell stop is just a future price or a future order which is placed below the current market price, which tells the market or which gives an order to the market to jump into the current sell trend once the market gets to that particular level. So let's just assume you were somewhere here, the current market price was somewhere here, and you knew very well that there's a potential for this market to keep going down, but you wanted to jump in at this particular level. So what you put here is a sell stop. And with that sell stop, immediately the market got here, the sell stop was triggered and the market keeps going down. So buy stop and sell stop, they are used for trend continuation. They are used if you know very well that the market will keep going in that particular direction. What you use is stop orders, buy stop or sell stop. But if you know very well that, okay, there's a possibility of a trend reversal and you want to catch reversals, what you use will be limit orders, which should either be a buy limit or a sell limit, if you want to be able to place a buy or a sell trade respectively. All right, so it's the same thing here. You can see here we have stop order, we have stop order here, we have stop order, and we have sell limit. So under stop order, they say order placed above the current market price, the current market price, and when price is rising. So this is just an example. So if the current market price is here, let's just assume this is the current. Let's just assume the current market price is here. You place your stop, you place your buy stop somewhere here. You can see buy stop. And immediately the market gets to that particular, immediately the market pierces through that buy stop, you get into the trade. So it's for trend continuation. And the sell limit, instead, the sell limit is placed above. A sell limit is placed above a current market price. That tells the market that, okay, you want to be able to cash a reversal if the market gets to that level. That's why you saw it came here, then starts going in the opposite direction. So the same thing, so when it comes to your chart, the orders that are placed above, let's just assume the current market price is here. The orders which are placed above the current market price can either be a buy stop, which tells the market that, okay, if the market from here keeps going up, I want to be able to jump in, or you can either place a sell limit above, which tells the market that, okay, if the market keeps going up and gets to this particular level, I want to be able to sell. So for any market, and the same thing goes for sell stop and buy limit. If you want to be able to place anything below the current market price, let's just assume the current market price is here. All right, let's just assume the current market price is here. What we can put here can either be a buy stop. If we put a buy stop here, it means we're telling the market that if the market gets here, we want to get into the trade, and we are presuming, we are guessing. Let me change the color. And we are guessing that the market will keep going up. So we are telling the market that, okay, if the market gets to this particular point, I want to get in at this point, and we are hoping that the market will keep going up. All right. But now, if we know very well that the market will instead get to this particular point and go down, what we'll use at this particular point will instead be a sell limit. All right, a sell limit. And for a sell limit, what we are telling the market is, okay, if the market from here keeps going up and gets here, I want the market to sell at that particular level. All right. So buy stop or sell limit. And if it is below the price, you use a sell stop, or you use buy limit. All right. So that is just what you have to understand when it comes to trading and when it comes to pending orders. Buy stop and sell stop. Buy stop and sell stops are used for trend control. Even when it comes to news trading, where I used to tell you guys about strategy, where you place your buy stop and your sell stop are below and above the current market price. That is when you are trying to catch the movement in the market. You know very well that, okay, if the news is released and it is positive, you want to be able to jump in. That's why you are using a buy stop. So that explains the reasons why when we trade a strategy, what we use is buy stop and sell stop. Since we are trading with a trend, buy stops and sell stops are used when you are trading with a trend. But if you want to catch reversals in the market, what you use is limit orders, which can either be buy limit or sell limit. All right. So with that being said, I think we've made ourselves very clear when it comes to buy stop and sell stop, and also come to sell limit and buy limit. So let's talk about stop loss order. This is the most common order when it comes to forex trading. The most common order when it comes to forex trading. You hear people talk of stop loss, use a stop loss on your trade. So it's still an order. Stop loss itself is still an order. Anytime you press that stop, that you push that, anytime you push that stop loss button on your chart, or you press the stop button, you are still placing an order. You are still giving an order to your trade. And what is a stop loss? An order placed to limit losses if the trade doesn't go your way. Simple, as simple as that. So a stop loss order is just an order placed to be able to limit losses if the trade doesn't go your way. As simple as that. So let's just assume you at this particular level. Let's just assume at this particular level you predicted very well that the market will bounce somewhere here and instead go up. All right. But when the market got here, you bought. So you buy somewhere here, you buy somewhere there. You were assuming that the market will continue going directly from here. But see what happened. Immediately you bought here, the market went against you. The market didn't go on your intended direction. So what will be able to prevent your account from blowing out will be what we call a stop loss. All right, a stop loss. So you place the stop loss below, any particular position to prevent your losses, so that if the trade goes against you, the stop loss will be able to limit those losses. That is why that brings us to what we call risk to reward. Risk to reward is just the amount you are able to gain based on each dollar amount you are investing. Because if I'm risking $1 here, how much can I be able to gain if I'm risking $1? If I'm risking $1 and I'm gaining $3, that means my risk to reward is 1:3. And if I'm risking $1 and I'm getting $4, it means my risk to reward is 1:4. That's where stop loss comes into place, because you use a stop loss to limit your losses. Anytime you place your trade, you need to be able to put a stop loss on it immediately. It should be like an oath. It should be like an oath. Anytime you place a trade, you need to be able to put a stop loss on that trade that is able to limit your losses if the trade doesn't go your way. So that's the simple explanation when it comes to a stop loss order, because that is still an order. After stop loss order, let's go to what we call trailing stop orders. So now, when we start talking of stop loss orders, like a stop loss and trailing stop, those are trade management orders. You are using them to manage the trade. Because if I could maybe let me put this again this way. In trading, you have what we call trade execution. Trade execution orders. All right. Orders. You have what we call trade execution orders. Under trade execution order, you have market orders, and you also have pending orders. All right. You also have pending orders. So all this, you have either market order or pending orders. They are trade execution orders, because you use them to execute. You use them to execute the trade. You use them to place the trade in the market. Those are the orders. They are like the triggers. Because when you are shooting a gun, you need where you call the trigger. So when it comes to trade execution orders, which can either be the market order or the pending orders, those are under here you have something, even the buy limit and the sell limit, sell limit, buy stop, sell stop, all of them fall under trade execution orders. After trade execution order, we have what we call, this is number 1. All right, that's number 1. After number 1, you have number 2, which is now what we call trade management orders. All right, trade management orders. Trade management orders. Under trade, so number 1 is trade execution orders. Those are the orders that allow you to place the trade. And then number 2, under trade execution orders, we have market orders and pending orders. Under number 2, we have now what we call trade management orders. Under trade management orders, we have stop loss order. We have stop loss order. All right, we have stop loss order, and we also have trailing stop order. All right, we also have trailing stop order. Okay, so you should be able to understand how it moves. You should be able to understand this system. So if I can go here, let me show you this so that you can be able to understand it very well. So let me just put this, let me put it like this. So let's go here, let's just go to any new form. Let me show you this on a new form, exit, yes. Let me show you this on a new form. So if you come here, we have a new form, we have this form, and I want to be able to explain that structure. I want to be able to explain that structure to you, all right? So here we have our market orders, or we have orders in Forex. Under orders in Forex, the first one we have is what we call trade execution. Trade execution orders. All right. Under trade execution orders, let me write this very well. Under trade execution orders, we have what we call market orders, and then we have what we call pending orders. So all of this, you have under trade execution orders, we have market orders, and we have pending orders. So all of this is under trade execution order, because this is what allows you to be able to place that trigger for a trade to be executed. But after the trade has been executed, we have another one which we call trade management. Trade management orders. I think I need this to go this way. Trade management orders. Under trade management orders, we have what we call the stop loss, and we also have what we call trailing stop. Trailing stops. All right? Trailing stop. Trailing stops. Good. So under trade management, after you've been able to place your trade, place your trade, now it's time for you to manage your trade. And under trade management orders, you have what we call stop loss and trailing stops. We already explained what is a stop loss. A stop loss is just an order which you place, and once you place a stop loss on your trade, it limits the losses if the trade doesn't go your way. But now, let's assume, what if the trade goes your way? What if you are in profit? This is how you are able to prevent your profit. So this is where a trailing stop will come into place. A trailing stop is just an order that blocks in, or that a trailing stops is just an order that blocks in profit once you are in profit. As simple as that. It's just an order that blocks in profit once you are already in profit. So see an example of this. Let's just assume we have our chart here. We have our chart here, right? And we bought somewhere here. The chart is going up like this, like this, like this, like this, like this. Good. We bought somewhere here. Here we buy somewhere here. And our take profit somewhere here. Let's just say our TP somewhere here, and our stop loss somewhere here. Since we buy somewhere here, what we can do is ask yourself, if the trade is actually going your way, how do you prevent your profit? Because you can buy somewhere here, the market go up by maybe a certain number of pips, then go against you, come and trigger your stop loss, or even blow out your account. So in this situation, what you use is what we call a trailing stop, which is just an automatic stop loss. A trailing stop is just an automatic stop loss, and it automatically blocks in your profit once you are already in profit. So at this particular point in time, once you buy here and you're already up with, let's say, plus 50 pips, what you do is you put a trailing stop. If your target is maybe 150 pips away, all right, what you come on your chart and you put a trailing stop of 50 pips. It's automatic. To put your trailing stop, I already have a video. Just go on the channel. You will see a video on how to put a trailing stop on your MT5. It's very easy. When you just right click on your MT5, you see a link that says trailing stop. It's very easy to put a trailing stop. So when you put that trailing stop, immediately the market goes up. This is how a trailing stops work, right? Immediately the market, if I buy somewhere here, let's just say I buy somewhere here, right? And my target is 150 pips away, and I put my trailing stop of 50 pips. Let's just say trailing stop of 50 pips, and I buy. Remember, I bought somewhere here. Buying somewhere here, if the market goes up by 50 pips, immediately it goes up by plus 50 pips. Since my trailing stop, if the market goes up by 50 pips, since my trailing stop is 50 pips, my stop loss will go up. My stop loss will automatically move to break even, because if I'm targeting 150 pips away, my stop loss might be 50 pips below the current market price. And since my trailing stop is 50 pips, anytime the market goes up by 50 pips, the chart will automatically move my trailing stop. So let's just assume I'm already here. My stop loss will move to break even. And if the chart continues going up and I move up to maybe plus 100 pips, all right, plus 100 pips, that means how many pips I've added? I've gained again more 50 pips. I'm already up with 100 pips. So my stop loss will automatically move from year to year. All right, so this is where I'll instead have my stop loss will instead be year instead of year. So my stop loss is following that winning position. As soon as I'm getting into profit and I'm going up, my stop loss is following the winning position. So let's just assume even here, if at this particular point in time where where I'm already up with 100 pips, the market happens to go against me. Even if the market happens to go against me, this trade is already safe. This trade is already secured. I already have my profit block in here, and I already have my stop loss here, and I already have some profit block in. So let's just assume even if the market comes like this, all right, even if we have a news and the market moves from 100 pips and it goes against us. If it goes against us, remember we have our stop loss here. We'll be stopped out somewhere here. That means the trade will be automatically closed here. Once the trade is automatically closed here, we'll be going out of that trade with plus 50 pips. All right, instead of going out with 0, or instead of our account being blown out, we'll be going out of the trade with plus 50 pips, because that stop loss was behind that position. That stop loss was behind that position, following that position. And even if the market has to go up to 150 pips, it's automatic. The stop loss will keep going up. That means the stop loss is preventing that position to say, okay, even if the worst has to happen, at least we'll go out of the profit out of the trade with profit, or in worst case scenario at break even. All right. So that is the most important thing you have to just notice, or you have to take down when it comes to trailing stops. It prevents or blocks in your profit once you are already in profit, or once you are already in the money. So with that being said, we've been able to come to the end of this episode, where we've talked about market orders. We've talked about other types in Forex. In Forex trading, we have two other types. We have trade execution orders. We have trade execution orders, and we have trade management orders. Under trade execution orders, those are orders that allow you to place your trade. Under trade execution orders, we have market orders and we have pending orders. Those are all under trade execution orders. And under trade management orders, we have what we call stop loss. We have a stop loss, and we have what we call trailing stops, because you use them to be able to manage your trade. So with that being said, if you've gotten some value from this video, please leave a thumb on this video. I've even seen situations where people ask me, like, if there's a way I could put more than one thumb up on these videos, I could put, but just one will do. Leave a thumb up on the video. And if you are watching and you haven't subscribed yet, please tell me how you'll be able to miss out valuable information like this. Do yourself a favor by subscribing to the channel, or also do me a favor by subscribing to the channel, because the more people subscribe, the more people like the video, I'll know you guys are actually getting more value from this course, and will come out with more relevant content like this. So also follow this playlist, which we're going to leave over here, and stay tuned, stay happy, stay profitable. Until then, I'll see you guys on another video. Peace.